About the Standard & Poor's 500.
So I'm measuredly enthusiastic, meaning we have to get through the next month or so because the kinds of risks you've been talking about, which is the UAW strike, yields at a cycle high, definitely present sort of wild cards to what is a reasonably good-looking fundamental picture. And of course, these are the things that could really derail the picture. I think that the S&P is typically soft this time of year. Why September and October, we can discuss at another time, but it is soft. And yet, we have not seen tremors really in the equity market of the kind we've seen in past years, given the risks that we're seeing. Suggests to me that we're probably going to muddle through, consolidate here. I do think there's some risk to 4,200 here, simply because that would be a reasonable way to absorb some of the yield increase that we've seen, and then move forward from there. I mean, in the end, we're going to finish this quarter at close to 3%. Very hard to get a recession when your GDP on a real level is close to 3%. So even if we slow in the fourth quarter, the year ends strong, we would assume still 40% chance of recession, because in the end, higher for longer means there's going to be further tightening here in the real economy.
Alicia, just want to get your thoughts on 2024. Max Kettner of HSBC was on the program with us a little bit earlier, and he said we need to focus more on what could go right because expectations for 2024 are so low. Do you agree with that, or would you take the other side?
So I would agree with that, and we actually did the same when we do our mid-year review, and that was released at the end of June, because we decided that the focus on the left tail risk had really not been fair to what's going on in the real economy. And in the end, the American consumer has really held up this economy here in ways that I don't think any of us expected at the beginning of the year. And so it's very important to really look at what the right tail risk can be. In the end, if we have no recession this year, the earnings picture can be closer to 225 by the end of the year, and then you grow from there for 2004. If you have between $240 and $250 per share for the S&P in 2024, markets can get over 5,000 to 5,200, which is what we have in print, and that really sets you up for a nice rebound even further from that. A slowdown is not a recession. In the end, even though vastly every time the Fed is tightened like this, we've had a recession, what's different this time is the antecedent, and the antecedent is 12 years of near zero rates. And as we know, that has cushioned households and cushioned corporates coming into this tightening cycle.
Everyone was saying that this rally had to broaden out to be sustainable, and it sort of did for a second and then backed away, and tech kept leading. Is that going to be the dynamic going forward? Because that is truly the growth area. And some of these other areas, like airlines, like auto manufacturers, face some of these headwinds that we've been talking about.
Right. So look, we do need to see the broadening out here. Look, in the end, 97% of the energy names in the energy sector are above the 200-day moving average. Only 62% in the tech sector are above the 200-day moving average. So it is broadening out in a way. I'd say this: I think that tech has to participate. It cannot lag. It cannot lag. If tech lags, it's going to be very hard to get the averages up. Obviously, it's simple math. 40% of the average is communication services and tech. So we do think that the yields here could put a ceiling on some of the multiple expansion that we've seen in the tech sector. But if earnings are moving higher overall, that will support the market.
How bullish are you? Just on a scale of full bull to bear, where are you kind of sitting at this moment?
As I like to say, we're paid to worry. And so I would call myself between a 6 and a 7. I think the fundamentals are very good in the real economy, understanding that there's some softness in some parts of the consumer sector, and yes, some bulking and paying some of those fees. Airline fares is a great example. But I do think overall the cushion that households have in fixed rate debt as well as the corporate sector, I think that's good. I worry more about a yield-induced issue somewhere, whether it's the corporate real estate market or elsewhere. I think that's the place we have to look to where this rosy story may stumble a little bit. So I see it less on the fundamental side and more sort of what's going on in the sectors that are really very sensitive to yield still.
Alicia, thank you. Just wonderful to catch up with you. Alicia Levine there of BNY Mellon Wealth Management, and thank you for sharing your vacation with us, which sounds absolutely wonderful, Tom. 2 AC Milan games, a trip to Monza, all in the space of a couple of weeks. Does it get any better than that?
You know,
just awesome.
It's like,
Slice of that for next year.
Lisa and I are working all summer, and we're in New York, and like the closest we got to an island, closest we got was an island called Manhattan, and
It's a great island. Lots of people
doing the George Clooney. You're doing a George Clooney imitation.
Alaska, Costa Rica.
Yeah.
It's you that didn't go anywhere.
Yeah, well, yeah.
If you're just tuning in, welcome to the program. The S&P positive here by 0.07%.
Now the latest news from New York City and around the world. Here's Michael Barr.
Tom, Lisa, John, 5 Americans released by Iran after being detained for years have arrived back in the U.S. It was part of a deal that saw President Joe Biden agree to the release of $6 billion in frozen Iranian assets. President Biden will speak this morning in New York at the UN General Assembly. World leaders will likely discuss war, climate change, and persisting inequality. India rejected allegations by Prime Minister Justin Trudeau that its government agents were behind the assassination of a prominent Sikh leader in Canada.
Over the past number of weeks, Canadian security agencies have been actively pursuing credible allegations of a potential link between agents of the government of India and the killing of a Canadian citizen, Hardeep Singh Nijjar.
Trudeau said he raised his concerns to Indian Prime Minister Narendra Modi at the G20 summit last week in India. A 29-year-old man has been arrested in the fatal shooting of Los Angeles County Sheriff's Deputy Ryan Klinkenbroomer in what is being described as an ambush killing. Live from the Bloomberg Interactive Broker Studios, this is Global News 24 hours a day, powered by more than 2,700 journalists and analysts over 120 countries. I'm Michael Barr, and this is Bloomberg.
The greatest minds in global credit meet at Bloomberg's London headquarters, and the surveillance team will be front and center. This is Tom Keene. Join Jonathan Farrow, Lisa Abramowitz, and me Thursday for a special edition of Bloomberg Surveillance with Apollo Asset Management's Jim Zelter on the risks, the opportunities forward, in depth.
Bloomberg Surveillance, live from the Global Credit Forum in London. Thursday morning at 10 on Bloomberg 99.1. Bloomberg, context changes everything.
A graduate with 3 degrees from New Jersey Institute of Technology, Robert Cohen chairs NJIT's Board of Trustees. He's also a top executive at medical device maker Stryker Corporation and helps recruit top talent from universities like NJIT.
If you look at where NJIT students are going, go to a career fair. There are lines of companies that want to get into the career fair, and it's because they see those students as practical, innovative. I can tell you for a fact, because we hire many NJIT graduates, these students can contribute right from the get-go. The guy who reports to me, who's in charge of all my implant development, NJIT grad. The guy who reports to me in charge of all my robotics development, NJIT grad. They contribute to the development cycle. They contribute to the testing. We have NJIT graduates in manufacturing. We have NJIT graduates in quality assurance. We have NJIT graduates in our computer science. These students are some of our best.
NJIT, New Jersey Institute of Technology. Learn more at njit.edu.
Now your 3-day weather forecast on Bloomberg 99.1.
High pressure remains located to the west of the district of Baltimore this morning. That means good weather continues. We'll have abundant sunshine, low humidity, and a high of 75 to 80 later this afternoon. Skies are clear tonight, 55 to 60, but it will be cooler in some of the suburbs. Back to sunshine tomorrow with highs close to 80 degrees. Sunny weather a little warmer for Thursday, highs 80 to 85. I'm Rob Carolyn with your 3-day forecast on Bloomberg 99.1.
Will the Fed hold rates steady as expected?
The Fed trying to back into the shrubs and disappear.
They're as data dependent as we've ever seen.
And will they keep one more hike in the dot plot?
The services prices are going to be a concern.
There is this risk maybe inflation starts to pick up again.
Trust Bloomberg for the fastest coverage and exclusive analysis.
We could see more headwinds.
They may actually tip the economy into recession before they start cutting rates.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg. Context changes everything.
Central banks don't actually set rates. They respond to the economy. The Fed, they are finally caught up with the curve. That doesn't mean that they're at the end, but they actually have a chance to pause. And so it's a toss-up there. But the Bank of Japan is actually potentially changing course.
Marvin Barth, founder of Thematic Markets. Can I just say how quick Bob Michael is? So I refer to Ian Steely as London's Bob Michael, and the real Bob Michael appears literally around the corner. Ian, does Bob let you go out anywhere without him? You know, it's
like the shadow of Bob Michael.
Seriously, is that what that is? Ian Steely is going to join us in just a moment. Really important statement has just come through from the UAW president, Sean Fain. I want to share it with you. The former president, Donald Trump, would very much like the support of UAW. I can tell you based on this statement, he's not getting that. Every fibre of our union is being poured into fighting the billionaire class and an economy that enriches people like Donald Trump at the expense of workers. We can't keep electing billionaires and millionaires that don't have any understanding what it is like to live paycheck to paycheck and struggle to get by, and expecting them to solve the problems of the working class.
And this is the charm of the President of the United States. We can argue about it all you want about, you know, money that's come in for Joe Biden late in his life, but his entire tenor here is, I was in Scranton, I've been at those kitchen tables, and all the other fancy people in Washington haven't.
That's the pitch. Here's the problem. Billionaires and millionaires. I would take that statement as not just pushing back against the former president, but perhaps the whole political class in Washington, D.C.
Yeah.
Many of which senators in that Senate currently are millionaires, and the president also is one of them as well.
And the calculation here, and I don't have any wisdom on this, is public sector and massively diminished private sector unionization. These are dialogues of another time and place, and the numbers aren't there like they used to be.
Well, my question is, we've seen Republicans try to court some of the Rust Belt and try to get and pick up some of the discontent that we've seen, and they have. And Donald Trump was planning to go there on September 27th to Michigan to stand in solidarity with the UAW in rival programming to the next Republican debate. Will he still go if this is the line?
What's he going to do? Is former President Trump going to say, I believe in a defined benefit program? I mean, those are the issues that we heard from Craig Credell that we aren't talking about now, besides pure wage, and are they going to make more than an Amazon warehouse worker?
I can't guess what Sean Fain is going to do, the UAW president, but if we were to base our assumptions on that statement alone, that is not a UAW president that wants to go out there and campaign with the former president, Donald Trump. And if the former president wants the support of UAW, based on what we just heard there,
I believe these executives, including Mari Barra, talking to David Weston, these are millionaires and billionaires. Well, maybe they're not billionaires. I don't want to stretch it too far. Maybe Bill Ford is. But the bottom line to your point on millionaires is that's a statement against the executives as well.
It's the political class.
Yeah.
Tom, the political class who have spent a life in politics. And I'm not talking about the former president here, obviously, but those who have spent a life in politics and have managed to amass amazing fortunes over that period. Okay, and the failure of them to protect the people that he's meant to represent that work through these institutions in Detroit.
In our Fed coverage tomorrow, this will be addressed. I can't imagine it has got to come up in the press conference. Michael McKee, of course, in attendance there, as always. Right now, this is always timely. Is Ian Steely with us? He's international CIO within global fixed income, currency, and commodities at JP Morgan Asset Management. He has to share a desk with Bob Michael when he comes into London as well. John, why don't you bring in Mr. Steely here, because you are...
I'm not sure Ian wants to talk to me anymore, but I'll try.
You know, more. I can see Bob over his right shoulder. Hi, Bob.
Ian Steely at JP Morgan Asset Management joins us now. Ian, fantastic to have you with us on the show. Let's just get straight into the bond market. We've got this amazing call from AllianceBernstein this morning, 250 on a 10-year. You and the team are pretty constructive on the long bond, let's say the 10-year. How are you thinking about what this offers currently at 433 on a 10-year in America?
I think you've got to say it's a pretty good valuation. You know, for those people who wanted, you know, to buy back into the bond market earlier this year, we had that rally. We've now sold off again. We're back at the highs of the cycle. When I look at what's happening on both the inflation picture, you know, we are trending down in core inflation over the last 3 months. The jobs picture is trending down as well. We know we've got student loan paybacks. We know we've got tax in California. We know we're coming towards the end of those excess savings. It feels like at 430, that's a pretty good environment to be buying back into the bond market.
Questions. I'll ask you a dumb question. Are you clipping the coupon, or can you really invest for total return in the next 12 months?
I think it's a total return. I think, well, firstly, you've got the coupon. 4.3%. That's some of the nicest yield that we've seen in 15 or so years. And then you have got an environment where if we do start to slow, the Fed does start to feel that growth slowing and they need to ease policy, then you're going to get some pretty decent capital returns. And if you look at previous hiking cycles, once the Fed pauses, the bond market does very well, and it does much better than cash.
So we're talking about the AllianceBernstein call of 2.5% on the 10-year by the end of next year. And John asked the good question of why, right? Is this because of a huge drop-off in growth or just a moderation in inflation? Is that sort of what's underpinning a Fed that reverts back down to something lower? What's your call? What's underpinning your bull thesis here on bonds?
I think it's a combination of two, both of those. So we are seeing that moderation in inflation. We are seeing inflation coming back down towards where the Fed would like it to be, and then we do see the growth weakness. And I think the Federal Reserve, and we'll hear from Powell tomorrow, I do think they believe that they are restrictive, and that as the lagged impact of policy, and I think a lot of people are saying, how lagged are these impacts? Well, I think actually, a lot of people invested, or a lot of people borrowed at very low levels, they've locked in those low yields, but they will start to come through, and I think that the lagged impacts are going to take a hit next year. So you are going to see that slowdown in growth.
So does this counteract this idea of Goldilocks forever that we were hearing from Max Kettner, or actually by John, but that he reiterated?
Max Kettner.
Max Kettner, that he said, or is this basically pushing back against that and saying this is something a little deeper than that and maybe a little bit more pernicious?
So we're obviously in this Goldilocks scenario at the moment. The market's basically picking up on the fact it's coming down, we're slowing from an inflation standpoint, but we're not rolling over just yet. But I think we can't have Goldilocks forever. We are going to start to see biting within the growth standpoint. And I think what's happened this year is we've had a lot of support. We've had a lot of support on the fiscal side. We still had all those payments, all those checks, all that monetary policy, all that fiscal policy that came through in the pandemic, wash its way through the system. I think we're now coming towards the end of that. This period, this Goldilocks, this slowdown period, is taking a little bit longer than we thought. But when you look at historical periods, again, there's very few instances, the mid-90s probably being the only one, where we've had that slowdown without dipping into a recession. But you always feel at this point that it is the Goldilocks. It is the best environment until we actually start to dip over.
Bramo wants to geek out, so we can, with a May 2050 Treasury bond. We did this great story in the last 24 hours about how it's trading at sub 50, the price damage done